What is going on, people? It's Matt from Liquid Loans, and in this one we're going to find out what stablecoins really are and have a look at a few of the different types. So with no further ado, let's go. A stablecoin is a cryptocurrency that's value is tied to a reserve asset such as the US dollar, gold, various commodities, or even other cryptocurrencies. Stablecoins add price stability to an often volatile and fluctuating decentralized finance ecosystem. Cryptocurrency is famously volatile. Take Bitcoin, for example, in its mind-blowing journey of over 6 million% in just under 12 years. It's had some mammoth dips along the way. For instance, in 2011 when it crashed 99% in a single day. Try telling that to the wife. A financial roller coaster crossed with a wild bucking bronco, but for those who are able to hodl onto their Bitcoin have now made a fortune. In contrast, stablecoins are the opposite of the bucking bronco. They're the sturdy wooden horse. They barely move because they're pegged to underlying assets in order to limit price fluctuations. But there can be differences in how they're pegged, which gives rise to the four main types of stablecoins. These are intended to be backed one for one by fiat currency, which means that fiat collateral should be held in reserve with the central issuer or financial institution, and its value should remain proportionate to the number of stablecoins in circulation. For example, if an issuer has $1 million of fiat currency, then they should only distribute 1 million stablecoins, each worth $1. Some of the best known stablecoins in this category are Tether, USDC, and Paxos. As the name suggests, this type of stablecoin is backed by another cryptocurrency, and the collateralization process happens on-chain using smart contracts. When you purchase this type of stablecoin, your crypto is locked into a smart contract and you receive tokens of equal value. You can then put your stablecoin back into the same smart contract to withdraw your original crypto that you put up as collateral. Instead of using fiat or cryptocurrency as collateral, algorithmic stablecoins use algorithms and smart contracts to manage the supply of tokens in circulation. The way this works is that when the market price falls below the price of the fiat currency it tracks, the algorithm reduces the number of tokens in circulation. Alternatively, if the price of the token goes above the price of the fiat currency it tracks, the algorithm mints new tokens which enter circulation to adjust the stablecoin's value downward. Commodity-backed stablecoins are collateralized by physical assets like precious metals, oil, and real estate. The most popular commodity to be collateralized is gold, and Tether Gold, DigiX, and Paxos Gold are three of the best-known backed stablecoins. Since commodities tend to fluctuate in price more than fiat, commodity-backed stablecoins have a greater potential to fluctuate too. Like everything in life, stablecoins come with various risks, those mainly being security risk, counterparty risk, and reserve backing risk. Security risk stablecoins must be held on a platform, whether in a crypto wallet or on an exchange, which presents the risk of software vulnerabilities. Counterparty risk stablecoins depend on both the party holding the reserve asset and the party issuing the coins. A breakdown in trust at any level can put your coins at risk. Reserve backing risk stablecoins depend on the value of the asset backing them. Without the reserve asset, the value of your coins cannot be guaranteed. Stablecoins are really only as stable as their underlying asset, and those pegged to commodities tend to be the least stable of them all. USDL, the stablecoin of the Liquid Loans protocol, is an algorithmic stablecoin that is over-collateralized and backed by the cryptocurrency PLS. It is pegged to the US dollar by always being redeemable for $1 worth of PLS inside the protocol. So it's much more stable than many of the other stablecoins out there. So what can you do with the Liquid Loan stablecoin USDL? The short answer is whatever you like. But before you blow it all in Vegas or on a blinged out new Rolex, let's look at some of the different ways you can acquire USDL. Firstly, you can borrow against your PLS inside the Liquid Loans protocol. In this scenario, you create a vault, decide your collateralization level, the minimum of 110%, and then voila, you've got yourself some shiny new USDL. Secondly, you can also receive USDL as a reward for staking the loan token. When you stake your loan tokens, you earn USDL and PLS as revenue from borrowing and redemption fees. And last but not least, you can just receive it as a payment or as a gift. Sending and receiving USDL peer-to-peer is just as easy with any other crypto, and since it's on Pulse Chain, it will be super cheap and fast to send. So now you've got some hypothetical fat stacks of USDL burning a hole in your MetaMask. Here's 4 ways to use it. Number 1. Transfer to your exchange. Once Pulse Chain and Liquid loans are live, next on the to-do list will be to get USDL listed on an exchange. From there you can cash out into fiat, send it to your bank account and go and spend it on anything your heart desires. Hey Siri, nearest Lamborghini dealership. 2. Buy more crypto if you want to. You can use your USDL to buy more PLS, HEX, loan or any other cryptocurrency to which there is an available pair. The blockchain really is your oyster. Number 3, you can provide stability by depositing your USDL into the Liquid Loan stability pool. By parking your USDL inside the protocol and helping to provide stability to the system, you get a portion of any vault's collateral that is liquidated in the form of PLS, and you're also rewarded in the loan token too. And number 4, become a liquidity provider by heading over to a DEX like PulseX and use it as half of the USDL or PLS pair, for example, and get some juicy LP rewards. So to sum it up, a stablecoin is a cryptocurrency that's value is tied to a reserve asset such as the US dollar, gold, various commodities or even other cryptocurrencies. The main risks are security risk, counterparty risk and reserve backing risk. USDL, the stablecoin of the Liquid Loans protocol, is an algorithmic stablecoin that is backed by PLS as collateral, and 1 USDL is always redeemable for $1 US worth of PLS. You can also use your USDL to swap into fiat, buy more crypto, provide stability, or even become a liquidity provider. The choice is yours, as real DeFi should always be. So I hope you enjoyed that video on stablecoins. If you like content like this, do hit that subscribe button and that bell icon so you're notified every time we drop new content on the channel. You can also tap the like button, share the video with someone who you think it may benefit, and if you're feeling very kind, drop a cheeky comment below for the algo. It does help us out. Thanks for watching, and I will see you on the next one.